Hi, and welcome back to our class in financial risk management. We've now arrived at chapter 6, in which I want to show you the fundamentals of financial derivatives, and we'll start with the valuation of linear assets. Why is that? Financial derivatives are, as the name suggests, more complex financial contracts and securities, which are based on simpler financial assets. And for the valuation of financial derivatives, we need to know a little bit more about the potential underlying assets. And so we'll start with the valuation of linear assets in chapter 6.1. And then I will explain to you what financial derivatives are, and we'll have a look at the Black-Scholes-Merton model as the most important model, I guess, for the valuation of financial options and also other derivatives. And then we'll see some alternative methods how to price these instruments. And then last but not least, in chapter 7, we'll see how these instruments can be used in financial risk management as hedging instruments. So we'll start with the linear assets. And the idea here is that financial derivatives are always based on some kind of underlying, on some other financial contract. And so naturally, to understand how these instruments are priced, we need to understand how the prices of the underlying securities are formed. And this is why we start with linear assets. And in essence, why are we looking at financial derivatives in the first place? It's all about hedging. We need instruments that can be used to minimize, especially the market price risk of other securities. And this is where financial derivatives have become more and more important over the last couple of decades. You can have a look at the Derivatives in Internal Models textbook by Hans-Peter Deutsch. This is actually described and shown in almost all good textbooks on financial risk management, but this one is, I think, at this point, this is actually quite neat. We'll start with equity investments, in other words, stocks. We've already dealt with stocks at several places and several points in this lecture. You've probably heard about stocks in other lectures as well. I will simply repeat what should be known anyway. Stocks are financial instruments that securitize participation rights in a joint stock company. You're a stock investor, which means that you own a part of the equity of the company, and your property right in that company is securitized in the form of a stock, of a share. Now, in Germany, we have nominal value shares, which are prevalent. They divide the share capital of the company, the equity capital, into a certain number of shares with a fixed nominal or notional value. And by acquiring such a nominal value share, the shareholder purchases a certain share in the company. And as a co-owner, the shareholder participates in positive and negative developments in the company. So if the company goes bankrupt, you will lose your investment. However, his or her liability is limited to the loss of the nominal value. So if you've bought a share of, say, 100 euros, you can only lose 100 euros. That's clear. Now, the definition of stocks shows that with an investment in a stock of a certain company, you as an investor, you acquire a number of rights. First of all, you have a voting right at the annual general meeting, bei der Jahreshauptversammlung. You're entitled next to a share in the company's profit in the form of a dividend payout. You also have the subscription right for new shares in the event of what we call a seasoned equity offering, an SEO, which is nothing but, you can say, a second IPO or a third IPO. If you are offering the shares of a company to the public for the very first time, this is called an initial public offering or IPO. If you raise capital, if you're in need of more equity, you do a season equity offering. You're offering new shares, and the previous shareholders, they have a subscription right, so they have they get, in a sense, preferential treatment. They are the first to which the new shares are offered to. And last but not least, in the case the company is liquidated, you have the right for a portion of the liquidation proceeds. If it's completely bankrupt, if there is nothing left, you would get nothing, and you don't need to pay up more than you've already invested. But if, for example, the company is liquidated and you get a cent on the dollar, you get this part of the liquidation proceeds. Now, this list shows that you have various rights as a shareholder. Most of them are actually extremely irregularly used. For example, the annual general meeting only takes place once a year. So most of the time, you're actually interested in the dividend payments and the ups and downs of the stock price. So as you can see here, the annual general meeting only takes place once. Hopefully, there is no liquidation at all. Also, it could be that the company doesn't do a season equity offering for a number of years. So it's actually dividends and changes in the stock price. So if we are interested in valuing the stock investment, it's all about dividend payments and the price of the security. So from a very short term, I would say speculative view, the dividend payments can be neglected. So for example, you buy in January and you sell in December, and there is nothing going on with the dividend payment. So actually, for the valuation of the stock, the price changes is all you're concerned about. So the price of the security is relevant as an influencing risk factor for the valuation. And the question that follows is, how can the current and future stock price be modeled? Now, theoretically, the fair price, the arbitrage-free price, the value of the investment, should result from your future expected payouts. And what would you get as a payout? Well, the company is worth, let's say, 1 billion in the future. Divide 1 billion euros market value by the number of shares outstanding, and you would get the your part in the value of the company in the future, and you would get dividend payments. So the fair price of the stock should result from the present value of all future payouts, and these should be the sale proceeds from selling the stock in the future and the dividends you get on the way along. So the value of the stocks could be determined simply by discounting a finite or a perpetual annuity of dividend payments, if, of course, if you keep the stock for all eternity. But in practice, this approach is associated with considerable uncertainties, especially because the dividend payments are, company managers try to keep them constant as possible, but usually dividend payments are also subject to strong fluctuations. Hence, what we do is that we try to come up with a distributional model for the stock returns instead. And we've seen in the last couple of lectures how you can use, for example, a normal distribution to model the stock price returns. You can also use a factor model in which we have certain idiosyncratic or macroeconomic factors that explain past returns. You might have learned about this in the asset pricing class by Professor Schumacher. But this is just a different way of modeling the stock returns. However, note that the fundamental difference between the two approaches, first of all, present value model versus a direct modeling of the returns, is that calculating the present value of the stock is a normative approach. So how should the price look from a theoretical point of view? What is the theoretical price of the stock? Whereas if you take a direct model, and we would probably call this a reduced model, not a structural model. In a reduced model, you're not so much concerned about the factors that drive the stock price, in this case, the payouts and the present value, but you simply take the stock returns as given, and you're trying to model it as best as possible. So you're trying a positive model in the sense that you're looking at which distribution models real processes the best. So that's one slight difference here. Okay, so we have stocks. Now, as a second important class of financial instruments, we want to look at interest rate instruments, or what we call them also fixed income products. Why fixed? Many cases fixed income, because these securities, they pay a fixed income in the sense that they do not depend on a market price. They do depend on an interest rate, and you get interest payments, and these should be fixed. Now, the main feature of interest rate instruments of fixed income products is that they securitize the right to one or more fixed or variable cash flows, interest payments, on future dates. Now, we have spot markets for these. They involve transactions in which we have financial instruments that are exchanged and paid out immediately. And the spot market can then further be distinguished into the money market and the capital market. Money is for all the securities that mature within 1 year. The capital market has longer maturities, usually more than 1 year, and we'll look at the latter. Okay, what is the first easiest example of a fixed income product of an interest rate instrument? A zero bond. You should know what a zero bond is, or a zero coupon bond. I'll give you a definition here. Zero bond is a security with only one single cash flow at the very end, at maturity. It's the nominal amount, and will be repaid at the end of the term of the zero bond without any coupon payments in between. So we have no interest payments before maturity. So if capital T is the term of the security, the due date, maturity, given a start date at small t equal to 1, then the cash flow is simply given by the repayment in capital T, which is large N. So that's notional amount. Okay. Now, value of the zero bond is quite easy to calculate. You simply take the notional value and you discount it using a relevant discount factor, a relevant interest rate. Now, as you can see here, this is BR from small t to capital T. This is the discount rate associated with the interest rate R and the remaining term capital T minus small t. On a side note, you will see that the discount factors, they are not written as something like this. They are written by BR from small t to capital T. There's a reason why I denoted the discount factors like this. This is the usual way how it is done in financial mathematics. Actually, if you take, for example, let's use this. If you have a price for a zero bond, it pays out 100 at the end. This is a zero bond with maturity 1, 2, 3, 4, 5 years. Now, what is P, the price? If we have a standardized notional value of 100, or we could also say of 1, then it is quite simple to see, and quite easy to see, that actually the price is what? It's this discount factor. The price should probably be, or should be lower than 1. So it could be, for example, 0.9546. Now, if we have the zero bond price, the zero bond price here is equivalent to the discount factor that is equivalent and gives you this price here. So the discount factor embedded in zero bonds is actually the discount factor here is actually the price. So if we have a risk-free zero bond, this needs to be risk-free. Otherwise, if we have credit risk, if we have default risk, this won't work. But if we have, for example, a government bond that is risk-free, then the only thing that drives the zero bond prices should be the term structure of interest rates. And the spot rates, they are embedded in the zero bond prices. So instead of writing this as a discount factor, we can simply multiply future payments with the corresponding zero bond prices and we get the same thing. We get a discounted present value here. So R is usually a function of the remaining term. That is, it's more complicated than a flat interest rate curve. But to simplify notation and to make all of this what follows a little bit simpler, we assume that the term structure of interest rates is flat. So we only have one interest rate R for 1 year, 2 year, 5 years maturity. Now, since the nominal amount of the zero bond is fixed, the fair value of the zero bond depends exclusively on this single interest rate R. And conversely, from the real price of the zero bond, the internal interest rate, the interne Zinsfuß of a security, can be derived. And as a sole risk factor, we see that for the pricing of a zero bond, we get the already well-known yield to maturity or the internal interest rate of the zero bond. No surprise, for the valuation of a risk-free, let's say government zero bond, it's just the interest rate or the yield to maturity that drives potential changes in the price of such a very linear asset. Now, if we consider the next interest rate instrument, we are led to what we call a floater or a floating rate note. A floater is a security whose cash flows are variable interest payments with repayment at the end of the term. And these variable interest payments usually refer to or are based on reference interest rate, like the 6-month Euribor, Libor, and they are equal to the interest that the nominal amount, N of the floater, has yielded with the reference interest rate over the relevant interest payments. And those variable interest payments, they are determined at the beginning of one interest period according to the then applicable reference interest rate. So let's say every start of the month, we have a fixing, and the interest payment is fixed, and it's paid out, let's say, at the end of the month. And at a point in time t, between those two fixings, only the interest payment fixed in t0 for period and payment in t1 is known, and in between, we only know this payment if we have t2. T2 is still variable, and as soon as we have the payment in t1, the payment in t2 is fixed, and this goes on and on. And in addition to the variable interest rate, sometimes the so-called spread or quoted margin can be agreed upon as a premium for default risk. So the spread or the quoted margin comes on top of the interest payment that needs to be fixed. So we have several types of floaters, money market or capital market floaters. In this case, the interest rates are linked to a money market or a capital market interest rate. We have caps and floors, meaning that the floating interest rate is limited upwards, and we have a cap, or downwards, we have a floor. We also have mixed floaters, collars or collared floaters, or reverse floaters, in which case for the reverse floaters, it's, let's say, 12% minus the variable interest payment. As you can see, this is reversed. We are now getting more money if the reference interest rate goes down. So that's a reverse floater. Let's assume that we are at time small t, and we know the fixing that is to be paid out in t1, that was fixed in t2, and we go on t2, t3, tn, and so on. The cash flows are then given as follows. We have the interest payment that has already been fixed. That is the interest payment in T1. It's quite simple. We take the notional amount, and we are now not interested in discounting. So we need to take the zero bond price that corresponds to our interest payment and to the discount factor we're using, and we revert the discount factor into an interest rate. Now, for all future variable interest payments, we get the following. We need to take what we now call the forward rate. That is the discount factor, aka the zero bond price, that corresponds to future payment from Ti-1 to Ti has already been fixed at point T. So we take this is the forward rate, times the notional amount, which will give us the still variable payment in the future after T1, so in T2, T3, T4, etc. And then times the notional amount, N. And if we rearrange this a little bit, this is simply converting the forward rate into spot rates. We have the spot rate, this is the discount factor, sorry, but it corresponds to a spot rate. The discount factor from T to TI minus 1 divided by the spot rate discount factor zero bond price for T to TI. And this gives us the variable payment in TI, which we don't know yet. So last but not least, at the very end, we get the notional back. So the repayment in Tn is N. And if we now calculate the present value of those three types of payments, the already fixed payment in T1, the notional at the very end, this is line 21, and all those variable payments in between, we get this as the present value and thus the fair price of the floating rate agreement, of the floating rate note. First payment already fixed, we know this, notional amount, and everything in between, which is depending on the corresponding forward rates or the spot rates and the discount factors. Now, if we simplify equation 2, actually this should not be equation 2, but actually equation 20, actually 19 to 21, used to be line 2. Okay. We can see that this is actually given by this difference. If we now extend this and write this down, the sum, we can see that it starts out with BR T 2 minus 1, so this is T1, minus BRT T2, okay, so I, the index goes to 3, so we have T2 minus T3, T4 minus T3, and so on. But what you can see is that we have minus T2 plus T2, so this vanishes. This becomes 0. It goes on. TT3 plus TT3 vanishes. Minus TT4 plus TT4 vanishes. And so on. And all those terms here cancel each other out. And what we are left is actually the very first one, BRTT1 minus, and at the very end, BRTTN, maturity. If we now include this in our formula, we can see that in the very end, the present value of a floater is given by the first already known discount factor times notional amount plus the already fixed payment in absolute terms. So present value is the sum of the nominal amount N and the already fixed cash flow discounted at the spot rate on the next interest rate T1. So one can see that actually a floater is nothing but a zero coupon bond with a nominal amount of N plus the fixed payment and a maturity of 1 period, or T1, for the first, when the first fixing takes place and the first payout for the fixing takes place. This is interesting for a number of reasons. First of all, we can see that the floater is actually similar to a zero coupon bond when it comes to valuation. But more importantly, you can see that even though the interest payments are variable and we have no idea how the interest rate, the variable interest rate, the reference interest rate will evolve in the future, we can still calculate the price today. Because one would think, if I were to tell you, well, I will pay you the, let's say, the 6-month Euribor interest rate over the next 20 years, you would probably think that, okay, for valuation, this is quite tricky because I don't know where the 6-month Euribor interest payment and interest rate will be in 10, 15, 20 years. However, for valuation, it doesn't make any difference. Why is that? Well, if we have a variable interest rate, you get higher. Let's say we have a notional amount of n, and we are somewhere in the future, let's say Tn. The idea is that if the reference interest rate goes up, you get higher payments. To calculate price, the value, we also have to discount this using then a higher reference interest rate. So all these effects will cancel each other out. When you have a variable interest rate, you get higher payments, but you have higher discounting. If you have a lower reference rate, you get lower payments and you have less discounting. So that's why, even though the reference interest rate can vary over time and you don't know how high or low your interest payments will be in the future, you can still calculate the value, the fair price of such a floater. And this is the pricing formula here. You take the notional and you only need the current interest rate level. Okay, now it's quite simple to also include a spread or a so-called quoted margin in the valuation. For this, for example, for a long position in a floater with spread K, you duplicate the payments from this floater with a spread by a portfolio that consists of a long floater with no spread, for example, LIBOR flat, that's what it's called, or a long coupon bond with a spread K as coupon, and a zero coupon bond short with a nominal value and maturity of the floater, which only means that actually you have, you have a coupon bond, 100 plus K, and you go short in a zero coupon bond, and it will look like this. And as you can see, we have 100 minus 100. So in total, what we get is the spread. And if we now add it to the floater, we get the floater with spread K. And with the zero coupon bond, this double repayment of the floater plus the coupon bond is offset in the end. And since this construction includes the separation of the interest payments from the repayment of the bonds, this is sometimes called valuation via stripping. You're stripping the coupons from the bond. Okay. Now, as we've seen, a floater in terms of valuation is nothing but a zero coupon bond. To be missing E. Thus, the only risk factor that influences the valuation of the floater is the discount factor BR, or alternatively the yield to maturity, which is the only risk factor. If you have a floater with a spread K with a quoted margin, obviously we also would need some risk factors that drive the credit risk of the bond. So now let's move from the coupon, zero coupon bond and the floater to the next thing, which is a coupon bond. A coupon bond is a security with a so-called coupon that determines a fixed interest rate K. And the cash flows from the interest payments of a coupon bond are equal to the interest that the nominal amount N bears, with the coupon interest K over the relevant coupon period. So when the bond matures, a repayment of C repayment results. So in between, we have the repayment here at the very end of the notional, and in between, we are using the interest rate K and we revert our discount factor back into 1 plus, or actually into k. So in the end, what we have here is k times m. Okay. Now, discounting the payment series with a reference interest rate gives us the present value of the coupon bond, which in turn, again, exclusively depends on the interest rate or the bond price as a single risk factor. And thus, we have the valuation, we have the fair price, and we know that the only risk factor that drives changes in coupon bonds, if they are risk-free, they're sovereign coupon bonds, the only risk factor should be the interest rate and the term structure of interest rates. Okay. Now, as a practical example, on this slide here, you can see a coupon bond from Daimler, taken from the investor relations website in 2019. As you can see, the guarantor here is the Daimler stock company. It is a 1 billion euros bond. Was, I think, settled in 2016. The coupon payment is on March 9th each year annually, starting in 2017. The repayment is 100%. And as you can see here, I think I have some, let me just see if, yeah, it's a 1.5% coupon. So this bond, for every 100 euros, you would get 1.5 euros annually. And this obviously includes the risk-free rate plus a credit spread for the default risk of Daimler. If Daimler defaults or were to default, we wouldn't get any money back. And the current price is 104.5 euros. So that's the current price. So quite simple, but very practical example. And how would you calculate the fair price? Well, very simple. We were to take, it was in 2019. So this is actually maturing in 2026. So if this is, let's say, was in May 2019, so we would have 1.5 in 2020, 21, 22, 23, 24, 25, and 26. So this is the cash flow stream of this bond. And if you now were to use the corresponding and the right reference interest rates, and if you have an estimate for the credit spread, you could discount this stream of cash flows and you would get the 104.5 euros. So that's the valuation of this bond. Now, another group of interest-bearing securities are interest rate swaps, or just in short, swaps. A swap contract is a financial contract in which we exchange interest payments, usually variable, for fixed. And in the simplest form, in a so-called plain vanilla interest rate swap, we are exchanging fixed interest rates for variable interest rates. And depending upon the type of fixed interest payment, the so-called payer or receiver swaps exist. And they can again also be held long or short. What is a long payer swap or a long swap? You pay fixed interest and you get variable interest, which is also equivalent to a short receiver swap. In the short payer swap, or just a short swap, we receive the fixed interest and we pay variable interest. So remember, a long swap is you get the variable interest payments, and the short swap, you get the fixed payment. And a long payer swap can also be understood as a portfolio of a short coupon bond with the interest rate of the fixed side as coupon and a long floater with the same notional. So what happens is, if we think about the valuation of such a swap contract, we could simply say, okay, we get K, and 100 plus K, And let's make that F for fixed. And we go short in a variable, in a floater variable. Sorry, minus. Okay. What you can now see here is, this is a bit easier to see. What we get in essence is F minus V, F minus V, F minus V. So this is what we receive fixed interest payment. We receive fixed, and we pay variable interest minus V, minus V, minus V. So this is a short swap. And you can see here how valuation is done. We need to take the price of the coupon bond, and we need to take the price for the short floating rate note. And well, this is a short swap. Here you have it for a long pair swap. And if you subtract now the price of the floater from the bond, or vice versa, for a short or a long swap, we should get the price for a swap contract. So the value of a long pair swap is simply given by the price of a floater minus the price of a coupon bond, and we are done. So swap contracts are very, very simple to price and to value in this case, because as you can see, they're simply the combination of a long coupon bond and a short floater, or vice versa. And if you have the prices on the market, you can simply calculate the price of the swap. Now, we have two basic procedures that exist for the valuation of an interest rate swap. We can either combine a floater and a bond, or we take the present values of the fixed and the variable side, and they are called the fixed or the floating legs of the swap. Now, the difference is always in the present values is always the price of the swap contract. And again, because a swap contract is constructed by combining a floater and a coupon bond, we can see that the only risk factor that is relevant for the valuation of a swap contract, in this case, is the reference interest rate and the term structure of interest rates. We can also, again, include default risks, but in the starting setup, where we have no risk, no default risk, interest rate is all we need. Now, the example of a floater shows that this risk may already have been priced into the interest rate with a spread of K. The question then is, what would happen if the counterparty's default risk changes? Now, recall the spread K was assumed to be fixed, but you can also think about including counterparty risk in the swap contract. So that's a swap contract. Next, we have a forward rate agreement. This is a forward transaction, and the forward rate agreement is an over-the-counter contract, usually an over-the-counter contract, with a fixed interest rate K being agreed upon between the two parties for a capital transfer of the notional amount N for the future period capital T to capital T dash. And the forward rate agreement can be seen as a future loan whose interest rate is already fixed today. By the way, you can actually get this as a retail customer as well. This is something that is offered by many banks now when it comes to mortgage loans, because banks know that if interest rates are close to zero, there's a good chance that in 1 or maybe 5 or even in 10 years, interest rates will increase again. So they are trying to sell forward rate agreements now to retail customers. If you know that your mortgage loan needs to be renewed, let's say in 3 or 4 years, you can already now agree upon a future loan and you can fix the interest payment right now. So unlike a bond, the position of the party receiving the amount N is called long, and the position of the party receiving the fixed income rate is called short. Now, the cash flows of this unconditional transaction, it's not an option. You have to enter the contract and everyone needs to pay up. The cash flows are relatively simple. In a long forward rate agreement, we have the payment N in time T and an outgoing payment at capital T dash. That is the nominal amount compounded with the interest K. Because this is close to a loan, you get N in capital T and you have to pay back in capital T dash. So this is actually the payment in T, and this is the payment in T dash. And you now, for the price of this forward rate agreement, which is only the difference in the interest rates in capital T and capital T dash, you can calculate the present values. And again, one can see only the term structure of interest rates is relevant as a risk factor for the pricing of this forward rate agreement. It's basically a loan, and the only risk can come from changes in interest rates. Okay. We also have interest rate futures. An interest rate future, for this we define a contractual agreement to buy or sell a standardized interest rate instrument in the future at a previously agreed price. So zero coupon bonds or coupon bonds can be used as underlyings, and the valuation of these futures usually includes the determination of the difference between the forward price of the underlying, that is the price of the underlying at the moment of the conclusion of the contract, not performance. Translation. And the exercise price. And the so-called accrued interest plays a role in the evaluation. That is, we have compensation payments for accrued interest claims on coupon bonds. This is actually what we call it in German Stückzinsen. As you can imagine, in a coupon bond investment, if, for example, if we take the example of a coupon from Daimler, the coupon payment was made on March 9th. But if you buy the bond, let's say on March 10th, you haven't received the payment, the coupon. If you now keep, or let's make a different example. If you buy the bond on March 8th, this would mean that you have only owned the bond for 1 day, but you would get the full coupon payment. So actually, this needs to be, the accrued interest needs to be reflected in prices, because you don't want to profit too much, or you don't want someone else to profit from the coupon payment if you were the one who owned the coupon bond for most of the year. So that's accrued interest, in German called the Stückzinsen, and also clean prices and dirty prices. Furthermore, in addition to interest rate futures, we also have forward swaps. They also exist. These represent a swap with a term over a future period from capital T to capital T dash. And the valuation of such forward swaps can be seen in analogy to the valuation of interest rate swaps, with the exception that forward rates have to be used instead of spot rates. And last but not least, we also have so-called forward bonds. They are also traded on the market. I don't want to go into the details here. Okay, so that's the valuation of linear assets. Why are they called linear? Because the price and thus the price risk, they depend linearly on the changes in the risk factors. If you have an increase or decrease in the interest rate, usually you will see a linear trend in the price. This is different for most financial derivatives, where actually we have a nonlinear relation between the risk factors and the prices of these instruments. And that's why next we want to discuss financial derivatives. Okay, I'll make a short stop here and get something for my voice, and then we'll continue in a minute.